Mr. Novak, welcome. Good to see you here. As a general rule, I would think that most companies don't favor unionization, and here are two of the biggest, Starbucks and Amazon, potentially facing a growing wave of it.
Yeah, I think you're absolutely right. Companies don't favor it for a good reason. Number one, I think you want to be in control of your destiny, and in this environment, you have to have speed, and unions can really slow you down. Put too much bureaucracy into your business at a time when you got to make decisions quickly and you got to adjust, and that's why I think the best companies are really focused on creating a culture where everyone counts, and obviously making sure that their wages are competitive. And I think in the case in Amazon and Starbucks, I believe that they will continue to be pretty much union free.
Yeah, I find it interesting you point that out because my impression has been that certainly Starbucks treated its workers pretty well generally with benefits and competitive wages for the sector that they're in. And while Amazon has a more controversial labor record, I would say, I thought sort of the same there too, that they were a little bit ahead of competitors in terms of progressive workplace policies and pay.
I think they are, and certainly Starbucks has been a leader in the industry. Starbucks has had some real challenges lately. They're really, they're kind of straddled between the third place where you used to go in and they call you by your name, and then there's been this whole digital revolution, which has caused a lot of change within that brand, and Starbucks had to really try to go after both, but certainly move into the digital world, and I'm sure that's caused some stress on the employee base and the relations. And I can't imagine our country without Amazon. I think Amazon is a great company that's had tremendous growth and provided countless jobs. And I think both of these companies are great American countries, and they've got to stay stay competitive.
So let's talk about the business that perhaps as well as any human being, and that's the quick serve restaurant business at Yum Brands, among other things. There's been a big push upward in wages in that sector. If you were running a company like Yum or like Starbucks or like McDonald's, how would you be dealing with that and protecting your business's margins when wages are going up as quickly as they have been in recent years?
Well, I think the first thing you have to be very top line focused, very growth focused. The best way to protect your margins is to grow your sales and get the additional flow through from every sales dollar. Certainly in a retail business like the restaurant business. But you really can't bank on that. So I think the smart executives say, okay, we're going to really go after the sales, but we got to also cover our costs and make sure our cost structure is competitive. And I think this includes really looking at your supply chain, leveraging your scale, working on process improvement that'll save money, make you competitive, and then obviously, I think at the last report, extent, you take the price increase.
Yeah.
I think those are the levers that you can really pull. But you just can't afford to bank on sales, particularly in a tough competitive market and economic market. So you really got to cover, watch your costs, watch your G&A, and unfortunately, in some cases, it'll mean job cuts.